Hello friends, today I am going to explain you again the same concept of Peter Lynch valuation from this book. The people who have asked me in comment section many doubts, and I think most of the people have not understood the basic concept what I wanted to convey in that video, that how to see a basic simple valuation trick. There are many methods of valuation: discounted cash flow, relative valuation, option based valuation. But in simple language for a layman, how he can analyze a stock, whether it is valuable or how much far it is from its current value will change each quarter. When the result will come, fundamental result will come, value will change. You have to keep analysis. It is not said that TCS will come 1654 someday. That was the meaning many of you have concluded from the video. So I will again like to tell you many things that I wanted to convey in that video, that I just wanted to show you a simple method of checking whether your stock is a value buying or a not. The book One Up on the Wall Street is a must read book. You can read that book, and Peter Lynch himself is known for simplifying things. What he want to convey to you is that always see that whether your stock which you are buying, that P ratio, current P ratio, TTM P ratio is less than the EPS growth rate or not. Now this EPS growth rate is the future EPS growth. So future EPS growth you can see from the Yahoo Finance that I shown you in last video. So I have explained you earlier in my videos the concept of PEG ratio. What is PEG ratio? P divided by growth ratio. P divided by growth. Here you can see. So I have told, and in that book also it is said, that PEG ratio should be less than 1. Now what it means? P divided by growth should be less than 1. Now our 5th class maths tells you that this EPS growth you bring here. So what will you will get? P should be less than EPS growth. P ratio should be less than EPS growth. So next time when you buy a stock, and if it is trading at a P ratio of 20, you always see whether EPS growth is more than 20 or not. If you are buying a stock at P ratio of 50, always see whether the EPS growth is more than 50 or not. If EPS growth is 50 or more than 50, your share is fairly valued. How it is? You can see here. Suppose the future EPS growth projection of TCS, which is 10.69, if this number is 27.17, suppose this number, from where we got 10.69, from Yahoo Finance, you have to come to analysis, and next year projection you can see here analyst has given 10.5% of projection prediction. In screener.com also you can see that TTM profit growth is only 7% for the TCS, 7% and 10%. So now it is 10% taken. Suppose this profit growth projection would have been 27.17%, same as P. Suppose higher growth would have been expected from this stock. What would happen? And the dividend yield is 0. Suppose dividend yield is 0. Suppose, for a second, just to simplify things, what happened? Your stock price is the fair value of the TCS. What is the current stock price? 36.57. Fair price is also 36.57. So for a stock to be called as fair value on its current value, the P ratio should be equal to the EPS growth, expected EPS growth. Suppose a stock is having, any stock is having EPS growth of 50, and P ratio is also 50. Then also the stock will have same price, fair price, as the current price. If the stock has a EPS growth of 100, more growth is there, and P ratio is currently 50, less than the EPS growth, what will happen? Fair price is 7,300, whereas current price is 3,657. So what you are thinking, TCS will go to 1600? No, this EPS growth you have to follow. When EPS growth will come, that time when the current price will become the fair value, that time you should buy. That was the only message I was trying to give. I am repeating, when in any share EPS growth will beat the P, when the EPS growth will be higher than the P ratio. Like suppose here EPS growth will come 60%, whereas your stock will be trading at 50, or your stock P would be around 20. Suppose here your stock PE would be 20 and you are getting a EPS growth of 25. This is the time you should buy, because that time the current value of your stock is undervalued. Any stock, here you, this TCS you remove, any stock X, if it is at a price of 500, suppose a stock is having a price of 500 and its future growth projection is 24%. One finance company I bought recently, which was trading at 500, its future EPS growth was 24, but the stock was available at a PE of 12, so its fair value was 1000. So I simply buyed it, because I know that it's lesser than, with this ratio you see here. Here, my dear friend, you see it came 2, and 2 is what? 2 is undervalued. This is how you should think about this valuation and this concept and this learning. Nothing more, nothing less. Hope you now understood the concept. This Excel link I have given in my old video also, and this video also I will give. You can put your things, numbers here, or in your mind you can see this thing. If PE ratio is 20, EPS growth should be more than 20. All the best. I will see you in next video.